Have you ever looked at the stock market and just wondered, how do the pros really figure out what a company is worth? Well, today, we're pulling back that curtain. We're going to dive into how Wall Street tries to see beyond the daily noise to understand a business's fundamental, true value. Let's kick things off with this idea from the author Michael Lewis. He basically says that if you can't even imagine something happening, you'll be completely blind to it, even when it's right in front of your face. And that really sets the stage for us. Because in finance, some of the biggest mistakes happen when we just can't imagine a future that looks totally different from the past.
And that leads us straight into a pretty dramatic, real-world story about what happens when that failure of imagination costs someone, well, $1 billion. Okay, so picture this, it's 2018. David Einhorn, a legendary hedge fund manager, goes on record saying Tesla is basically a house of cards. And you know what? He wasn't some lone wolf here. At the time, Tesla was just burning through cash, they were struggling with production. A lot of serious analysts agreed with him. So he put his money where his mouth was and made a huge bet that Tesla stock was going to crash. Now, Einhorn's thinking was actually perfectly logical. He was using what we call a top-down view. He saw the big picture. Interest rates were going up, the car industry was already packed, and Tesla had a mountain of debt. Seemed like a fatal combination, right? But what he missed was the bottom-up reality of the company itself. He saw a car company, but he missed the disruptive innovator that was scaling at a crazy pace with a brand that people were fanatical about. So, what happened with that bet? Well, the result was nothing short of breathtaking. Tesla's stock didn't just go up, it just exploded. Between 2019 and 2021, the price shot up by more than 1,000%. It was a surge that made Elon Musk the richest person on the planet, and yeah, it cost David Einhorn's fund millions upon millions of dollars. So you have to ask the question, how on earth could a brilliant, data-driven guy like this get something so spectacularly wrong? Well, the answer really gets to the heart of the two very different ways you can analyze a company. I want you to think about it like this. It's the difference between using a telescope and using a microscope. Yeah, they're both incredibly powerful tools, but they show you completely different pictures of the universe. So, the telescope view, that's top-down analysis. This is exactly what Einhorn was doing. You start by looking at the biggest possible picture, the entire economy, interest rates, GDP growth, all that stuff. Then you zoom in a bit to look at a specific industry. And only at the very end, once you have all that context, do you finally look at the individual company. And then you have the microscope view, which is bottom-up analysis. This just flips that whole process on its head. You start by putting one single company under the microscope. You obsess over every detail, its management, its products, its business model. You totally ignore the big picture market noise at first, and only way later do you step back and consider the industry and the economy. And as you can probably guess, there are some pretty big trade-offs. The top-down view is amazing for spotting huge economic shifts, but you risk completely missing a game-changing company like Tesla. On the flip side, the bottom-up approach gives you these incredibly deep insights, but you could get totally blindsided by a massive recession that you just weren't paying any attention to. Okay, so whether an analyst is grabbing their telescope or their microscope, what are they actually looking for when they dig in? Let's get inside the analyst's toolkit. One of the first things they'll look at is the industry life cycle. You have to know what stage an industry is in. Is it in that early, exciting pioneering phase, like electric vehicles were in the 2010s? Or is it in decline, like print newspapers? Where an industry is in that cycle tells you a ton about its potential for growth and its risks. Next up is a classic framework called Porter's 5 Forces. Honestly, this is basically just a stress test to see how profitable an industry can be. It asks a bunch of questions. How hard is it for new companies to jump in? How much power do your suppliers and your customers have over you? Are there easy substitutes for your product? And just how nasty is the competition? But really, all of this digging, all this analysis, it's all a hunt for one thing, a strong, durable competitive advantage. The legendary investor Warren Buffett has a great name for this. He calls it a moat. Like a castle surrounded by water. It's that unique thing that protects a business from all the invaders and competitors trying to take its market. And you want a perfect example of a moat? Look no further than the Amazon flywheel. It's just genius. A better customer experience brings in more traffic. More traffic attracts more sellers. More sellers means a bigger selection. All that growth gives them a lower cost structure, which lets them offer lower prices, which leads to, you guessed it, an even better customer experience. It's this powerful, self-reinforcing engine that just keeps getting stronger. Which brings us to the ultimate goal of all this work. The economic outlook, the industry analysis, the hunt for a moat, it's all designed to answer one single question. What is this company actually worth?
And that right there is the biggest challenge. It's not about what a company made last year. It's about what it's going to make for years, even decades into the future. So how in the world do you put a price tag on the future?
Well, the most popular way is a method called discounted cash flow, or DCF. Now, the math can look really intimidating, but the idea behind it is actually beautiful and simple. First, you just forecast all the cash you think a company is going to make, forever. Step 2, you figure out how risky those forecasts are. And then third, you use that risk level to figure out what all that future money is worth in today's dollars. That's it. Now, this is what a real-world DCF model can look like. This one's for Home Depot. And yeah, there are a lot of numbers here, but don't get lost in the weeds. All those projections, year after year, all those calculations, they're all just serving that same simple three-step idea we just talked about. Project the cash, assess the risk, and find out what it's worth today.
Okay, let's zoom back out and tie all of this together. Bring it back to that opening story. Because this is really about seeing beyond the raw numbers. It's about blending the art and the science of analysis.
See, the big lesson from David Einhorn and Tesla isn't that one way of looking at things is right and the other is wrong. It's that the really great analysts, they learn how to balance both. They use the telescope to see the big economic storm clouds on the horizon, but they also use the microscope to find those truly special companies that are thriving down on the ground.
And you have to give him credit. Einhorn owned his mistake. His own words really say it all. We believed Tesla would fail as a business. We were wrong, spectacularly wrong. He had all the data from the telescope, but he completely missed the story that was happening in the microscope. And that kind of leaves us with a final thought to chew on. The data, the numbers, that stuff is essential. It tells you exactly where a company has been. But the story, the vision, the innovation, the moat, that tells you where it might go. So the real question for anyone looking at a business is, which one are you listening to?